fixed rates are out. Now, I am on a floating rate myself, so I do understand the pain. And especially if you are taking a new condo, going to TOP next year, or if you are buying a new house, this tutorial will definitely help you. I've looked through some of the packages and I've findings, some of which I like, some of which I don't like. So hopefully my perspective can let you understand what suits you potentially a bit better. So if you're keen to find out, continue watching on. Hi guys, welcome back. In today's tutorial, I'll only be covering OCBC, UOB and DBS. Of course, the other banks out there have their own unique packages. But the recent news is that these three banks have finally given a fixed rate package. If I'm not wrong, the foreign banks are still pretty reluctant to offer and compete in that segment. So I guess many of you guys also bank with either of these three banks. For myself, I bank with OCBC, and that's where we'll get things started. You know, OCBC, when I dig around their website, I couldn't actually find their fixed rate package details, But what's mentioned by Straits Times is that OCBC is offering right now 1-year fixed rate at 3.35% and 2-year fixed rate at 3.5% per annum. And before you get further, my perspective of fixed rate is really like an insurance, which means you are paying above the floating rate right now so as to lock in the rate. Make sense? So naturally, the fixed rate is above the floating currently. So if rates go up, you benefit. Or if rates don't go up, you're actually paying that excess. That's what made me choose a floating rate. But little did I know, mortgage rates would skyrocket that much in this year. Right now, I'm paying almost $1,000 more than what I used to. And I've actually covered that in a previous video, how much I'm actually spending on a month-to-month basis. So you can check out the video and I'll leave it towards the end of this also. So let's look further at this. OCBC actually offers floating packages and the details can be seen on their website. Straight off, I can share with you that they are unique in the sense they offer a 1-month SORA. SORA is Singapore Overnight Rate Average, and that is a more transparent benchmark. How it works is that now in this rapidly escalating phase, the 1-month rate would be showing a big jump very quickly because they're the most sensitive, correct? So 3 months is like an average of 3 months. So in this upcycle, the 1 month would climb faster than the 3 months. And conversely, when rates come down sometime in future, hopefully sooner than later, the 3 months will come down slower than a 1 month. And as you know, banks always check with them when you can reprice, when you can refinance, what is your lock-in. But as of now, I think quite sensible, you should look for the 3-month SORA instead of 1 month because we are in the escalating phase. Maybe in a down cycle, that's where you can reprice. Look for the 1 month because that should tumble faster than the 3 months. Make sense? So over here, we can see that OCBC uniquely offers a 1-month SORA. The spread is SORA plus 0.98. This is also the lowest across the 3 banks, unless UOB has a promotion, which I'll cover in a quick while. So the minimum size that OCBC is expecting for private is 300,000, for HDB is 200,000. So with that, let's move on to UOB, which just I've kind of touched on a little bit. UOB offers a promotional rate right now, which is 3 months SORA plus 0.7% for the first 2 years. Now, the lock-in is only 2 years, which is good because year 3 increases to 0.8%, correct? As you can see over there. But the minimum loan size required for this promotion is 500,000. If I'm not wrong, if the loan size is less than that, we might need to use the 1% plus 3 months SORA spread. Also, a highlight over here, UOB has mentioned that the 3 months SORA right now is 1.928% as of 27 September. But that number is actually wrong. They should update that number because right now it's 2+%, and I'll cover that in quick while because DBS's website reflects that. As to the T&C, this one you probably need to check with UOB because they really didn't leave too much details of it. I also couldn't find their fixed rate package, even though they mentioned you can complete the contact us form, and they do actually have a combination of fixed rate and floating package, but that information is only when you get in touch. So we do have to rely back again on the Straits Times article's figure. You'll see that UOB offers a 2-year fix at 3.75 and 3-year fix at 3.85%. Wow, that is the highest across the 3 local banks, correct? And in my opinion, if you are so keen on 3-year fix, might as well go with DBS, right? Which I'll cover next. And for 2-year fix also, it's probably the least attractive. So my gut feeling is UOB is really chasing the floating package. That's why they have a promotion for 500k and above. And for fixed rates, it's kind of maybe for existing customers who want to do a reprice. You know, in terms of mortgage, there's system reprice and refinance. Reprice is when you stick with the existing bank. And if I'm not, you can do it faster. Whereas for refinancing, you are changing banks. So there can be legal costs and other stuff inside. And as always, if you're unsure, check with a mortgage consultant. I do have contacts and I'll leave links below just in case you want an introduction. With that, let's move on to our biggest and final bank for today, which is DBS. And before we get there, help me smash on the like button because it's taken our team hours to prepare this presentation for you and hopefully you have benefited from it. Now let's look at what DBS has to offer. Well done DBS for actually putting all the rates there, because as consumers, we want transparency of information first before doing a contact, and that's something I appreciate. So we can actually find these details on the website itself rather than referring to Straits Times article just in case the numbers are incorrect or outdated. So for fixed rates, DBS is actually doing 2-year, 3-year, 4-year and 5 years. And everything is fixed at 3.5%. You can choose whichever duration you want, but later I'll give you a tip. The minimum loan amount is only 100,000, and take note again, after the fixed period, the plan floats at 3 months SORA plus 1%, which is what is reflected across all the various packages. Uniquely for the 5-year package, you can see right at the bottom, special feature, there is a waiver of commitment if you're selling a house 36 months into this mortgage contract with them, which I think is reasonable because just in case there are housing change needs, correct? So that actually allows you to get across, which means there's no point taking the 4-year fixed than the 5-year. You might as well get the 5-year and have that exit clause because just in case you need to sell your house. Do note again, for fixed rates, it means you cannot prepay the loan early. You are fixed, what? Which means you cannot also break the contract early. So there are cons when you are thinking about fixed rate. Floating, you can do partial repayment early, and if you are past the lock-in period, you can exit anytime you like. Especially if you are a first-time homeowner, these are terminologies you definitely need to get used to. Towards the end, I'll be covering what is my preferred package, so stay tuned to it. But let's touch on some other packages that DBS is actually offering. This one is not available for most of us. This is actually a 3-year fix, CHR plus 0.1%, and CHR is actually CPF OA rates as mentioned at the bottom. So this is very much like HDB housing rate. Commitment 3 years mean 100,000, and this again is for borrowers with income of 2,500 per month and below, so for lower income families. In this space, I do think might as well go to HDB loan rather than come to DBS, because HDB loans, I'm sure there are less legal fees and stuff. And as you know, HDB side, I guess they're a bit more lenient when it comes to social service office and stuff, especially for lower income families. But I also do understand that some of them have actually maxed out their HDB loan eligibility already, if I'm not wrong. So they might only have this solution to look at. But again, this is not applicable for most families, especially those with double income. As for DBS, their floating rates are 3 months SORA plus 1%. The min amount is 100,000, which is the least of the three. So just in case you have almost paid up your home loan, then maybe this is attractive for you to consider. The interesting part about DBS is they have their own FHR 6. FHR 6, again, if you don't know, is DBS's 6 months Singapore dollar fixed deposit rate for amounts less than $10,000. Currently, the rate is 1.4%. 1.4% plus 1.3% spread is only 2.7%, less than the SORA package as of right now. But hold on to that. The 6 months fixed deposit rate is going to skyrocket, so don't jump on it because it's 2.7% now. The 1-year fixed D is more than 2.6% already. This rate, I'm pretty sure, would escalate quite a lot. So you might get a shock, especially if you think, okay, my rate is 2.7%. Do expect that to eventually cross the 3%. That's in my personal opinion. Without the lock-in, you need to pay a bit more, which becomes FHR 6 plus 1.75% per annum in spread. I think this package, no point looking at it, in my opinion, again. Because why have that flexibility when you need to pay so much more in terms of spread? To me, it doesn't quite make sense. I would rather lock in for 2 years, because ultimately 2 years is still not such a long time. But the creative part that DBS actually has is this 2-in-1 home loan package. Now, in my opinion, this is new. I'm not too sure if other banks have it. UOB obviously is offering something right now in concurrent with this. But I've never seen a fixed plus floating kind of a combination structure. I know other banks like StanChart, they have one whereby you have a deposit account, they would pay the same interest as per what they charge for the mortgage. Something like that, which I guess will get increasingly popular, especially as a pitch to customers that, hey, high interest wouldn't affect you too much because you can get high interest in your savings account. But frequently when you scrutinize the details, you realize that there is a min that doesn't pay that much or something like that. And the net effective interest you get from it is actually not that high. So I'm not a fan of those. But I'm looking at this myself a bit deeper. Especially option A. Because if you want to hybrid it, why only fix 30%? You might as well fix 50%. That's the real risk, right? When it comes to floating and fixed, do you need the insurance of fixed? If you're okay to pay it off anytime, you have a lot in CPF OA, you have 300,000 in CPF OA, your loan is 200,000, then why not? You can actually just use floating. You're not afraid if it goes to 4%. Therefore, the whole idea, in my opinion, of fixed is when you have a portion that you're unwilling or unable to pay off. And in my strategy, I think option A, locking in 50%, which is close to $1 million right now, makes a bit of sense because I won't be paying off that in the next 2-3 years at least. Then the rest of the floating, if I have capital, if I have bonuses, I want to pay off early, I might exercise to reduce that floating portion of 50%. So I think it's a good offering. I hope more banks copy this and compete on this. But kudos to DBS right now for creating something creative, and I'll be very keen on option A. And just as a further tip, I do have the DBS multiplier. Right now it's not in use too much. But if you understand how the multiplier works, is that you credit salary in, plus you have a home loan in, you can actually qualify for tiers whereby it gives you higher interest. How the DBS multiplier works right now is there are certain categories, credit card spending, home loan, plus the salary. You can easily get 2 transactions, at least that's for myself. So I'm really targeting this first 50,000. If I have my mortgage inside, my salary inside, I think this 1.4% is pretty easy. And then for the next 50,000, 2.4% is also potentially possible. And since you stuck to here, let me round up everything with the summary table again. In this table created by Straits Times, you realize that there are a lot of packages. I'd like to help you suggest what I think doesn't quite make sense, and let's start with that. I think the OCBC fixed 1 year doesn't quite make sense, although it's 3.35% per annum only. Why so? Because I do think that interest rates are not going to come down that quickly. This is something that PM Lee has mentioned also. Higher interest environment is here to stay, at least for the foreseeable years ahead. So 1 year fix, you might as well not fix at all. At least explore the 2 or 3 year period. Then what about the 5 year fix? I think that's also a bit excessive. Interest rates are not going to stay high forever also. If a recession comes, you need to understand that the rate hike cycle might taper off. So fixing for 5 years is a commitment, is insurance against rising rates for possibly way too long in my opinion. I have suggested 5 year fix for my private clients before, especially those at 1.5, 1.8%, but 3.5%, I think no point fixing it because CPF OA can only give you 2.5. And if you're concerned about mortgage too much, that means the amount that you've taken up could be actually uncomfortable. So the best solution was to prevent taking an unnecessary big home loan that you cannot pay off very quickly. Then what about for non-fixed packages? I think I've mentioned very favorably on DBS's hybrid, which is 50% fixed, 50% floating. When my RHB1 completes, I will explore this option, possibly on a 2 or 3 year basis. Or I could fully pivot to UOB if they're still willing to do their promotional rate of 0.7% spread plus 3 months SORA. Again, that's likely the most attractive floating package in the market, and the min is 500,000. So as always, thank you for watching to here, and hopefully it's benefited you. I'd like to introduce you to some of my previous tutorials also. The first touches on why I may not be contributing that much to CPF moving forward, and quite obviously, interest cost is so expensive, I might as well pay off interest cost, correct? So check out that tutorial. With that, I'll sign off. Thank you for watching. Goodbye.